Hello everybody, I'm delighted to be here to talk about the Hong Kong Stock Exchange's proposal to increase the profit requirement for companies applying to list on the main board. The Stock Exchange's proposal to increase the main board profit requirement is set out in its consultation paper published on the 27th of November 2020. If adopted, the proposal would impact the Hong Kong market considerably, with the Hong Kong Exchange's own impact study assessing that of the 745 companies that applied to list under the main board's profit test between 2016 and 2019, 59%, that's 437 companies, and 65%, that's 486 companies, would have been ineligible for listing under each of the two options proposed by the exchange. The consultation is open until the 1st of February 2021. Chapter 8 of the Hong Kong Exchange's rules sets out the minimum requirements that a listing applicant must meet to be considered eligible for listing on the main board of the exchange. These include 3 financial tests: the profit test, the market capitalization revenue cash flow test, and the market capitalization revenue test of the listing rules. That's in 8051, 8052, and 8053. Listing applicants have to satisfy one of these financial tests, although alternative tests apply for certain specific types of company, such as pre-revenue biotech companies under Chapter 18A and mining companies under Chapter 18. Looking first at the current profit test under Listing Rule 8051. This requires the listing applicant or its group to have profit attributable to shareholders of at least 20 million Hong Kong dollars for its most recent financial year, and aggregate profit attributable to shareholders of at least 30 million for the 2 preceding financial years. The profit test is based on profit attributable to shareholders, that's post-tax profit. In calculating the profit, listing applicants are required to exclude any income or loss of the listing applicant or its group generated by activities outside the ordinary and usual course of their business, the profits of any associated companies of the listing applicant, and of any other entities whose results are recorded in the listing applicant's financial statements under the equity method of accounting are also required to be excluded. Companies listing under the profit test are also required to have an expected market capitalization of 500 million Hong Kong dollars at the time of listing under Listing Rule 8092. This was increased from 200 million in February 2018. As for the other 2 financial tests, both cater for larger companies. The market cap revenue cash flow test requires a listing applicant to have a market cap of at least 2 billion Hong Kong dollars at listing, revenue of at least 500 million for the most recent audited financial year, and positive cash flow from the listing applicant or its group's operating activities of at least 100 million in aggregate for the 3 preceding financial years. The market cap revenue test caters for companies that can't meet the profit requirement but are substantial in terms of market cap and have generated significant revenue. These are usually companies that are capital intensive in nature but have a long development curve. They will be eligible for listing if they have a market cap of 4 billion Hong Kong dollars and revenue of at least 500 million Hong Kong dollars for the most recent audited financial year. The consultation paper's proposed changes relate only to the profit requirement. As you can see from the table on the slide, the exchange is proposing to increase the current profit requirement by either 150% under option 1 or 200% under option 2. Option 1's proposed 150% increase is based on the percentage increase in the market cap requirement to 500 million Hong Kong dollars in 2018. This would increase the minimum amount of profit attributable to shareholders from 20 million Hong Kong dollars to 50 million Hong Kong dollars in the most recent financial year before listing, and from 30 million Hong Kong dollars to 75 million Hong Kong dollars in aggregate for the 2 preceding financial years. Option 2 would increase the profit requirement by 200% from 20 million Hong Kong dollars to 60 million in the most recent financial year before listing, and from 30 million to 90 million in aggregate for the 2 preceding financial years. Option 2's proposed 200% increase is based on the approximate percentage increase in the average closing price of the Hang Seng Index from 1994 to 2019. As for the rationale for the proposed increase in the profit requirement, the exchange points to a misalignment between the current profit requirement and the 500 million Hong Kong dollar market cap requirement. The exchange believes that this has given rise to concerns regarding the quality of companies seeking to list on the main board. Essentially, that these are not genuine listing applicants, but are companies listing as shells intended to profit in future from acting as a vehicle for a backdoor listing. Shell companies in the past have attracted a substantial premium. In the consultation paper, the exchange states that there's been an increase in listings by small cap issuers, which it defines as companies with a market cap of 700 million Hong Kong dollars or less, which marginally meet the current profit requirement, but have relatively high historical PE ratios in comparison to their listed peers. The exchange is questioning whether the valuations for these companies were genuine or whether they were reverse engineered to meet the 500 million Hong Kong dollar market cap in order to create a listed shell. In addition to addressing these regulatory concerns, which are predominantly focused on small cap issuers, the exchange is of the view that an increased Hong Kong exchange profit requirement will create a clearer distinction between the exchange's main board and GEM and offer companies a clearer choice and investors greater clarity. The exchange has explained that there are no other regulatory concerns in relation to the other aspects of the profit test. The exchange has no concerns regarding the spread of profit between the first 2 financial years and the last financial year, or the use of post-tax profit attributable to shareholders rather than pre-tax profit. Similarly, it's not proposing any change to the provisions excluding the profit contributions of the listing applicant's associated companies and other entities whose results are recorded in the listing applicant's financial statements using the equity method of accounting. The requirement for the exclusion of profit or loss generated by activities outside of a listing applicant's ordinary and usual course of business will also remain unchanged. Similarly, there's no proposed change to the market cap requirement, which a listing applicant must also satisfy under the Hong Kong Exchange's profit requirement. The consultation paper notes that the combination of the exchange's profit requirement and the market cap requirement is intended to provide a comprehensive examination of a listing applicant's historical performance and a forward-looking indicator of the market's potential interest in the listing applicant. If the proposed changes are adopted, the exchange is also proposing to introduce temporary conditional relief from the increased profit requirement to facilitate the listing of quality companies whose financial results have been temporarily and adversely affected by COVID-19 and the accompanying economic downturn. This is similar to the possible waiver from the profit test requirement for main board listing applicants and the exemptions that were made available to listed companies conducting spin-off transactions, which were introduced in June 2009 to make allowances for companies whose profits were temporarily adversely affected by the 2008 financial crisis. In proposing that waiver, the exchange recognized the general limitations of the existing profit test as an indicator of a listing applicant's future performance in circumstances where the performance of the listing applicant's business may be significantly affected by external factors beyond the control of its management, such as economic downturns and recessions. Interestingly, the exchange's 2009 announcement of the possible waiver noted that certain market participants had expressed views that the existing profit test may not be a useful indicator of an applicant's future performance, and that some had questioned its appropriateness as an eligibility requirement for listing. The Hong Kong Exchange said that they would review the existing profit test and other components of the eligibility requirements at a suitable time, but this finally took place in 2017. However, respondents to the 2017 consultation generally supported retaining the exchange's profit requirement and maintaining it at its current level. This is something I'll talk about in a bit more detail later. If the proposed changes are adopted, in order to qualify for the temporary relief from the spread of profit between the first 2 financial years and the most recent financial year of the listing applicant, the applicant will have to meet a number of conditions. The first condition is that the listing applicant must have an aggregate profit for the track record period that meets the aggregate profit requirement. That's 125 million under option 1 or 150 million under option 2. Secondly, the listing applicant has to have a positive cash flow generated from operating activities in the ordinary and usual course of business before changes in working capital and taxes paid in the last financial year of the track record period. The third condition is that the listing applicant should be able to demonstrate that the conditions and circumstances leading to its inability to meet the profit spread of the profit test are temporary. The exchange will assess the applicant's profitability in the latest financial year or period, that's a stub period, to assess whether the listing applicant has recovered or is recovering from the adverse market conditions. The next condition is that at least 6 consecutive months of the listing applicant's track record period must fall within the 2020 calendar year. This is because the relief is intended for listing applicants whose financial results for the track record period have been adversely affected by the economic downturn of 2020. Where a listing applicant is eligible for relief from meeting the profit requirement spread requirement, it will be required to make additional disclosures in its listing document. It will be required to disclose the likelihood of the continuance or recurrence of the circumstances leading to its inability to meet the spread of the increased profit requirement, and the measures that were taken or will be taken by the applicant to mitigate the impact of those circumstances on future profitability. The applicant will also be required to include in its listing document a profit forecast covering the period up to the forthcoming financial year end date after the date of listing, with detailed bases and key assumptions. The profit requirement will have to be reviewed and reported on by the listing applicant's reporting accountants, and the applicant's financial advisor or sponsor will have to confirm that it's satisfied that the directors made the forecast after due and careful inquiry, as required by Listing Rule 1117. All listing applicants seeking temporary relief will be required to submit an application to the exchange for consideration. The exchange will consider these applications for temporary relief on a case-by-case basis. The exchange is aware that some companies may have already commenced their plans to list on the exchange's main board based on their current profit requirement. To limit the impact that the proposed changes may have on these companies, the exchange has developed and will implement certain transitional arrangements. The exchange hasn't disclosed an implementation date for the proposed increase in the profit requirement, but has said that it will not take effect before the 1st of July 2021. Therefore, listing applicants who are preparing to list as at the 27th of December 2020, being the date the exchange published the consultation paper, will have sufficient time to prepare and file their listing applications before the increased profit requirement takes effect. The effect of this is that companies applying to list on the main board, including GEM-listed companies applying to transfer their listing to the main board, who submit their listing applications before the increased profit requirement takes effect, will be assessed under the current profit requirement, provided their listing application remains active as at the date the new requirement takes effect. An application made before that date may be renewed once within 3 months of the lapse of the previous application and will be assessed under the current profit requirement, but any subsequent renewals will be assessed under the increased profit requirement. Following changes made to the GEM listing rules in 2018, transitional arrangements were put in place for companies which were listed on GEM or which applied to list on GEM before 16th of June 2017. These companies are defined in the listing rules as eligible GEM issuers. GEM transfer applications to the main board, which are submitted by eligible GEM issuers between the 15th of February 2018 and the 14th of February 2021, will be processed under the transitional arrangements set out in Appendix 28 to the main board listing rules, which include a market cap requirement of 200 million Hong Kong dollars. These GEM transfer applications, which are submitted by eligible GEM issuers before the 14th of February 2021, but which lapse after submission, will no longer be entitled to the transitional arrangement and will have to comply with the current profit requirement and the capitalization requirement of 500 million Hong Kong dollars. However, as the proposed implementation date for the increase in the profit requirement will fall after the 14th of February 2021, these GEM transfer applicants will also be assessed under the current profit requirement, provided their application remains active as at the date the increased profit requirement takes effect. A listing application will be considered to be active if it hasn't lapsed for more than 3 months and it hasn't been withdrawn, rejected, or returned. The consultation paper points out that a listing applicant will be prohibited from withdrawing its application before the application lapses and subsequently resubmitting the application prior to the date the increased profit requirement becomes effective. The current minimum profit requirement was introduced in September 1994 and has remained unchanged through 2 public consultations and 2 reviews by the Exchange's Listing Committee conducted between 2002 and 2017 on the basis that it continued to be a good indicator of a listing applicant's performance and that it was on par with the main markets of other stock exchanges, including the Australian Stock Exchange, the London Stock Exchange, Nasdaq's Global Select Market, the New York Stock Exchange, the Singapore Stock Exchange, and the Shanghai Stock Exchange. Meanwhile, the market cap requirement of Listing Rule 8092, which a listing applicant relying on the profit requirement must also meet, was increased in February 2018 from 200 million Hong Kong dollars to 500 million Hong Kong dollars. The exchange says in the consultation paper that since the increase in the market cap requirement, there's been a significant increase in applications from listing applicants who only marginally meet their profit requirement, but have relatively high proposed market caps. In the consultation paper, the exchange provides a breakdown of the number of listing applicants relying on each of the 3 financial tests between 2016 and 2019. Of the 908 companies that applied to list on the main board in that period, 82% applied under the profit test, while just 1% applied under the market cap revenue cash flow test and 4% applied under the market cap revenue test. The remaining 13% were applicants relying on the alternative tests for companies with weighted voting rights, mineral companies, pre-revenue biotech companies, secondary listing applicants, which are innovative companies listed on the New York Exchange, Nasdaq, or the premium segment of the London Exchange, and the investment funds listing under Chapters 20 and 21. Of the 82% of main board applicants which applied to list under the profit test between 2016 and 2019, 51% were small cap issuers. That's companies with a market cap of 700 million Hong Kong dollars or less. Most of these companies were in traditional industries, property and construction, consumer goods, industrials, and so on. Meanwhile, the market cap requirement, which a listing applicant relying on the Hong Kong Exchange's profit requirement also has to meet, was increased in February 2018 from 200 million Hong Kong dollars to 500 million Hong Kong dollars. Since this increase, the Hong Kong Exchange says in its consultation paper there's been a significant increase in applications from listing applicants who only marginally met the exchange's profit requirement but had a relatively high historical PE ratio compared to those of their listed peers. The 2002 consultation on the proposed amendments to the listing rules relating to initial listing and continuing listing eligibility and cancellation of listing procedures, which was part of an effort to enhance the quality of companies listing on the exchange and bring Hong Kong's requirements into line with international standards, opted to retain the current profit requirement. That's the 20 million in the most recent year and an aggregate of 30 million for the 2 preceding years. This was based on the consideration that the current level of the profit requirement was on par with other leading markets, namely the New York Exchange and other leading markets in the Asia-Pacific region. The exchange has also proposed using pre-tax profits to meet the profit requirement rather than post-tax profits, which was in line with international practice. Although this proposal was supported by a majority of respondents to the consultation at the time, some expressed concerns that the use of pre-tax profit would effectively lower the profit requirement and that tax could significantly affect listing applicants' profit in some cases. Others were concerned that the use of pre-tax profit for meeting the profit test could cause confusion, as post-tax profit was used to derive indicators such as PE ratio and earnings per share. The exchange ultimately decided to retain the use of post-tax profit. The 2002 consultation also proposed changes to allow greater flexibility in its spread of the aggregate profit, so that at least 20 million Hong Kong dollars could be attributed to the first 2 years and to the most recent financial year of the track record period. This proposal was not adopted, as most respondents considered that the existing requirement worked well and wasn't proving problematic for listing applicants. In 2017, as I mentioned, the exchange again launched a consultation, this time on a review of GEM and changes to the GEM and main board listing rules. Again, the exchange opted to retain the profit requirement as one of the tests for determining an applicant's eligibility to list on the main board, and to retain it at the current level. It was, however, proposed that the market cap requirement under Listing Rule 8092, which a listing applicant relying on the profits test must also meet, be increased from 200 million Hong Kong dollars to 500 million. As outlined in the consultation conclusions, respondents generally agreed that the profit requirement was a good indicator of a main board listing applicant's future performance, and 56% supported retaining the profit requirement at the current level, noting that it was on par with the majority of the overseas main markets reviewed by the exchange for the purpose of the consultation. 13% of the respondents opposed retaining the profit requirement at its current level, with some saying that the exchange's profit requirement should be increased if the proposal to increase the main board's minimum market cap was adopted, which it was. The exchange agreed with the majority of respondents, saying that it was unnecessary to change the current level of profit under the profit requirement. As for the proposal to increase the market cap requirement, 50% of respondents supported it on the basis that an increase would better differentiate between the exchange's main board and GEM, and increase the main board's competitiveness in attracting large and prominent enterprises to Hong Kong. The 30% of respondents who opposed the increase were concerned that the increase was excessive and would prevent smaller, profitable companies with good potential from listing on the exchange's main board. They also expressed concern that an increase in the minimum market cap requirement, together with a proposal to retain the current level of profit under the profit requirement, would increase the implied historical PE ratio significantly to 25 times, from 10 times under the existing listing rules. Respondents further emphasized that this increase in the implied historical PE ratio would lead to an unbalanced development and composition of industries of companies listed on the main board, particularly given that old economy companies have inherently lower PE ratios at the current time. Some respondents therefore suggested alternative measures, such as increasing the minimum market cap requirement to 300 million and increasing the level of profit in the latest financial year under the profit requirement to 30 million Hong Kong dollars to maintain the same implied historical PE ratio of 10 times. Ultimately, the exchange adopted the proposal to increase the minimum market cap requirement, but retained the profit requirement, saying that it did not believe the increase would result in an unbalanced composition of industries of companies listed on the main board, and that an implied historical PE ratio of 25 times for a new applicant wishing to list on the main board under the proposals would only be required if the applicant met the profit requirement and the revised market cap requirement exactly. It observed that in practice, most listing applicants achieved profits and had market caps exceeding the exchange's requirements. As briefly mentioned earlier, the exchange outlines in its consultation paper that since the increase of the market cap requirement in 2018, the exchange has seen an increase in listing applications from small cap issuers that only marginally met the Hong Kong Exchange's profit requirement, but had relatively high historical PE ratios as compared with those of their listed peers. The exchange notes that the average historical PE ratio of the Hong Kong Exchange's profit requirement applications from 2016 to 2019 was 14 times. However, the proportion of exchange profit requirement applications with historical PE ratio above 15 times increased significantly in 2018, following the increase in the market cap requirement. While these small cap issuers justified their higher valuations by reference to potential growth, the exchange says that a number failed to meet their profit forecasts post-listing, calling into question the reasonableness of their valuations. For example, whether valuations were actually supported by a real expectation of growth. The exchange's concern appears to be whether these small cap companies are effectively engaged in the manufacture of listed shells, an activity it has been trying to suppress for some time, primarily through increased tightening of the rules on reverse takeovers or backdoor listings. The interpretation of the suitability criteria for listing has also been progressively expanded to try and prevent prospective shells from listing, notably under Guidance Letter 6813A. The exchange questions in the consultation paper whether small cap issuers genuinely listed on the exchange's main board with the intention of raising funds for the development of their underlying businesses, as stated in their profit forecasts, or whether these small cap issuers have been inflating their valuations to meet the market cap requirement in order to manufacture shell companies to sell post-listing, given the perceived premium attached to the listing status. In the exchange's view, this potentially impacts the quality of main board listings and confidence in the market. If the valuation a company achieves on listing is not genuinely supported by the market, there's a risk that the price will drop post-listing, causing losses for investors and loss of investor confidence in the shares. The shares may also become susceptible to speculative trading and excessive price volatility post-listing if inadequate market demand results in thin trading and low liquidity of the shares. The exchange considers the misalignment between the profit requirement, which has been unchanged since 1994, and the increased market cap requirement, which has increased fivefold from 100 million in 1994 to 500 million, to be a primary cause of these problems. The exchange says in the consultation paper that the inflated valuations also raise the concern of whether or not the IPO offer prices of these companies genuinely reflect the expected market clearing prices. It claims that the price discovery process may have been compromised in certain instances, possibly by rebates being offered to investors to entice them to subscribe for shares. The exchange also suggests that there have been instances of abusive behavior, such as the manufacturing of an artificial shareholder base. The exchange explains that these practices go against one of the fundamental principles of the listing rules, that the issue and marketing of shares should be conducted in a fair and orderly manner. The exchange's view that the listing of companies with a market cap below 700 million are potentially engaged in listed shell manufacture is, however, some would say open to question. It would be surprising if all these small cap companies were involved in shell manufacture. A market cap of 700 million Hong Kong dollars is not insignificant, and in an attempt to prevent the listing of shells, the exchange needs to make sure that it's not getting in the way of the listing of quality smaller companies and SMEs. Since the introduction of more stringent rules for reverse takeovers and the amendment of Guidance Letter 6813A to curb shell creation activities in 2018, it seems less likely that companies would be successful in listing on the main board for the sole or main purpose of creating a listed shell. Also, if companies are listing with excessively high PE ratios, as the exchange suggests, the problem is potentially not that the profit requirement is too low, but the market cap requirement is perhaps too high. The consultation paper compares the financial eligibility criteria of the exchange's main board with those of 6 overseas main markets: the Australian market, the premium segment of the London Exchange, Nasdaq's Global Select Market, the New York Stock Exchange, and the main boards of the Shanghai and Singapore stock exchanges. When compared with the New York Exchange and Nasdaq's Global Select Market, the main board's current profit requirement under Listing Rule 805 is lower than both the New York Exchange and the Nasdaq earnings requirement. However, it's important to highlight that the profits test requirement in Chapter 8 of the listing rules is based on the profit attributable to shareholders, that's post-tax profit. The New York Exchange and Nasdaq earnings requirements are based on the listing applicant's pre-tax earnings. In addition, the exchange's listing rule 805 requires that a listing applicant, when calculating its profit attributable to shareholders, must exclude any contribution from any associated companies and other entities whose results are recorded in the listing applicant's financial statements using the equity method of accounting. However, neither the New York Exchange nor Nasdaq require a comparable exclusion. The premium segment of the London Stock Exchange's main market doesn't have a profits requirement or an earnings requirement, while the New York Exchange's and the Nasdaq's earning requirement is a standalone listing test with no additional market cap requirement tied to the earnings test. This is in contrast to the profits test under Chapter 8 of the exchange's listing rules, which requires a listing applicant to satisfy both a profit requirement and meet the minimum 500 million Hong Kong dollar market cap requirement. The London Stock Exchange only has one test which all applicants have to satisfy. It requires all listing applicants to have a market cap of at least £700,000. That's under 8 million Hong Kong dollars, which of course is considerably lower than the minimum market cap requirement for listing on the exchange's main board. There are other requirements which include that 75% of the listing applicant's business must be supported by a 3-year historic revenue earning record. The listing applicant must control a majority of the assets and have sufficient working capital. London Exchange's market cap requirement is significantly lower than the market cap of the exchange's main board, of course. Compared to the Australian Securities Exchange, the Nasdaq Global Select Market, the New York Exchange, and the Singapore Exchange's main board, the Hong Kong Exchange's main board is the only jurisdiction which does not have a standalone profit requirement. The London Exchange, as mentioned, doesn't have a profit requirement at all. The Shanghai Exchange's main board has a profit test coupled with a share capital requirement, but also offers 2 alternative tests, a revenue test and a cash flow requirement. The New York Exchange also has different listing criteria for domestic listing applicants and foreign listing applicants. For a domestic listing applicant wishing to list on the New York Exchange, 2 tests are available. These are an earnings test, which, as I already mentioned, is a standalone test, and a global market capitalization test, This gives a domestic listing applicant a choice of tests which focus on different criteria which do not overlap. Although the Hong Kong Exchange's main board provides listing applicants with 3 tests, it's arguable that the New York Exchange's domestic market provides for greater flexibility, notwithstanding that it only has 2 tests. This is because the 3 tests of the Exchange's main board are interrelated in that they share criteria. For example, each of the 3 tests requires that the listing applicant has a minimum market cap, and 2 of the 3 tests require the listing applicant to have a minimum revenue. In addition, the Hong Kong main board's alternative tests cater only for very large applicants, given that they require a market cap of 2 billion Hong Kong dollars and 4 billion Hong Kong dollars and 500 million in revenue in the most recent audited financial year. That they only cater for a minority of listing applicants is clear from the fact that only 1% of companies applying to list on the main board between 2016 and 2019 applied under the market cap revenue cash flow test, while 4% applied under the market cap revenue test. If the main board profit requirement is increased as proposed under either option 1 or option 2, the Exchange's main board will have the highest 3-year aggregate profit requirement of all the main markets reviewed in the consultation paper, including the New York Exchange and Nasdaq. Notwithstanding this, the Exchange is of the view that the proposed changes will effectively address the issue of companies listing with high historical PE ratios. To this extent, the Hong Kong Exchange is of the view that increasing the profit requirement will reduce the implied historical PE ratios to a level similar to that seen before the increase of the market cap requirement in February 2018 from 200 million to 500 million. Of the companies applying to list on the Exchange's main board under the profit test between 2016 to 2019, options 1 and 2, as I mentioned, would have resulted in 59%, that's 437 companies, and 65%, that's 486 companies, of the applicants being ineligible for listing. Under both options, 46% of ineligible applications were small cap issuers with proposed market caps between 500 million and 700 million. None of them were new economy companies, and they had a median historical PE ratio of 14 times. Comparatively, 10% under option 1 and 3% under option 2 of eligible applications had proposed market caps between 500 million and 700 million, with median historical PE scores of 8 times. 22% under option 1 and 25% under option 2 of ineligible applications were non-small cap issuers with proposed market caps exceeding 700 million Hong Kong dollars, with median historical PE ratios of 27 times under option 1 and 26 times under option 2. 87% under option 1 and 95% under option 2 of eligible applications were non-small cap issuers with market caps exceeding 700 million, with a median historical PE ratio of 16 times under option 1 and 15 times under option 2. Approximately 30% of ineligible applicants would not have been eligible under the current regime because they had market caps of less than 500 million. And listed under the pre-2018 market cap requirement of 200 million. Of the ineligible listing applicants, 46% of these were small cap issuers, while a minority were non-small cap issuers, meaning that at the time of listing they had market cap above 700 million Hong Kong dollars. So the data provided by the Hong Kong Exchange illustrates that the class of listing applicants that will be impacted the most by an increase in the Hong Kong Exchange's profit requirement will be small cap issuers. While being mindful of this impact on small cap issuers seeking a listing on the main board, the Exchange notes that these companies would not be precluded from accessing the Hong Kong capital markets as they could seek to list on GEM. This aligns with the Hong Kong Exchange's goal of further differentiating between main board and GEM listings in an effort to improve the overall quality of the Exchange's main board issuers, which it claims will strengthen Hong Kong's position as an international financial centre. The proposed changes will also impact transactions such as spin-offs, the objective of which is to effect the separate listing on the exchange or elsewhere of part of a listed group's assets or businesses. The Listing Rules Practice Note 15 provides that where the company to be spun off, the new entity is to be listed on the exchange, it has to satisfy all the listing rules requirements which apply to new listing applicants. These include the basic listing criteria of Chapter 8. After the new entity is listed, the listed parent company is required to retain sufficient assets and operations of its own, excluding its interest in the new entity, to independently satisfy the requirements of Chapter 8. The exchange will not allow the new entity's business to support two listings, the parents and the new entities. If the proposed increase in the profit requirement is implemented, this will make spin-offs extremely difficult, as both the new entity and the parent company will each have to satisfy the increased profit requirement. As the exchange makes clear in the consultation paper, its objective is to position the main board as a market for sizable companies that can meet high market standards. It believes that this will improve the qualities of companies listing on the main board and increase investor confidence in the Hong Kong market, further enhancing its position as an international financial centre. This objective, of course, is with much merit, and we need to recognise the exchange's tremendous achievement in attracting the listings of some of China's most successful companies, such as Alibaba, NetEase and JD.com, under a new path to Hong Kong's secondary listing for Chinese tech companies already listed in New York or London. The exchange's April 2018 listing reforms, which also made it possible to list tech companies with weighted voting rights structures and pre-revenue biotech companies, were instrumental in enabling the exchange to regain its position as the world's top IPO fundraising exchange in 2019 and in 2018. Hong Kong ranked second in 2020 after Nasdaq, with a total IPO fundraise of just under 400 billion Hong Kong dollars from 146 IPOs. This makes 2020 Hong Kong's most active year for IPOs since 2011. The secondary listings of 9 US-listed China-based companies accounted for 34% of IPO funds raised in 2020, while 22 healthcare life sciences IPOs accounted for around 25%. There are, of course, different views on the proposals depending on who you talk to. While the exchange's success in listing China-based tech and healthcare life science companies is remarkable, some feel that it could do more to cater for Hong Kong's smaller, growing companies and SMEs. Mid-sized Hong Kong and China businesses will be excluded from the main board if the proposed increase in the profit requirement goes ahead. Unlike mainland companies, many Hong Kong businesses only have access to the Hong Kong Stock Exchange as a domestic fundraising platform. This will impact not only these potential issuers, but also Hong Kong's corporate finance industry. The consultation paper suggests that these companies could instead list on GEM. Listing on GEM is, however, far from straightforward. As I mentioned earlier, Guidance Letter 6813A was revised in 2018 in order to curb shell company listings. Criteria which are stated to be characteristic of shell companies are also typically true of many good quality smaller companies and SMEs, characteristics such as having a small market cap, only marginally meeting the listing eligibility requirements, and applying a high proportion of the IPO's funds raised to pay their listing costs. As a result, many genuine SMEs find themselves having to convince the exchange that they're not listing as shells. A number are rejected for listing. The process for listing on GEM is also typically lengthy and expensive, given the amount SMEs and smaller companies typically raise. If the exchange wants to encourage smaller companies to list on GEM, it might consider a further consultation to simplify the application process to make it a more attractive option. It's worth noting that the New York Exchange, NASDAQ and London exchanges provide far more diverse markets than Hong Kong does at the present time. NASDAQ has 2 other markets in addition to the Global Select market, whose requirements are compared to those of Hong Kong's main board in the consultation paper. NASDAQ's global market and capital market have much lower listing requirements than Hong Kong. The London Exchange also has 3 segments on its main market, a premium segment, a standard segment, and a high growth segment, with lower entry requirements than the Hong Kong main board. It also has a separate market, AIM, which has minimal listing requirements and is aimed at providing a capital raising platform for SMEs and growth companies. London and New York both provide far more comprehensive markets than Hong Kong, which allow the listing of a broader spectrum of companies, both in terms of size and jurisdiction of incorporation. Hong Kong could consider creating different segments to its main board, with a premium segment catering for very large companies, a standard segment for mid-sized companies. GEM could also act as a board for smaller companies. Another possibility would be a new third board for listing smaller tech and other innovative companies for which there's currently no viable listing venue in Hong Kong. The exchange could also consider companies in Belt and Road companies, the Greater Bay Area and ASEAN countries. Charltons responded to the consultation paper on 11th of January 2021 on behalf of a group of Hong Kong sponsor firms, and this makes many of the points I've just raised. The response is available for downloading on our website, charltonslaw.com. So if you're interested, please have a look. For anyone who's interested in responding to the consultation themselves, the deadline is the 1st of February 2021. So that brings us more or less to the end. If you have any questions I haven't dealt with, perhaps email me on juliacharlton@charltonslaw.com. I'll do my best to try to get back to you. So thank you very much, and I hope you enjoy the rest of this week.